Gentlemen, good day and welcome to the Q4FY23 earnings conference call of Deepak Nitrite Limited, hosted by IIFL Securities Limited. At the outset, I would like to clarify that certain statements made or discussed on the conference call today may be forward-looking in nature. And a disclaimer to this effect has been included in the results presentation shared with you earlier. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Akul Broachwala from IIFL Securities Limited. Thank you, and over to you, sir.
Thank you, Michelle. Good afternoon, everyone, and thank you for joining us on Deepak Nitrite's Q4 and FY23 earnings conference call. Apologies for the delay. Today we have with us Mr. Maulik Mehta, Executive Director and CEO, Mr. Sanjay Upadhyay, Director Finance and Group CFO, and Mr. Somsekhar Nanda, CFO. To begin with, Mr. Maulik Mehta will share views on operating performance and the growth plans of the company, followed by Mr. Sanjay Upadhyay, who shall take us through the financial and segmental performance. I now invite Mr. Mehta to share his opening comments. Thank you, and over to you, sir.
Good day, everyone, and a warm welcome to Deepak Nitrite's Q4 and FY24 earnings conference call. I hope you've had an opportunity to go through our results documents that were shared earlier. We entered 23 with a very challenging business landscape characterized by diverse internal and external factors. The Russia-Ukraine war has served to fracture the global supply chain for crude, fertilizers, petrochemical derivatives, and specialty chemicals. Led to large rises in input prices across the board, resulting in a secular inflationary pressure, unlike anything witnessed in the recent past. The cascading effects of central banks across the globe raising interest rates rapidly, leading to a higher cost for capital even as forex volatility rose and risk spreads expanded. Internally, we were faced with a shutdown of our Nandesari plant for more than 40 days due to a fire in June. There were challenges and constraints to logistics coupled with a rise in utility costs. Amidst this volatility in spot prices, both customers and suppliers were seeking to capitalize on short-term opportunities, even as they sought assured supply and purchase agreements. Notwithstanding these adversaries, we were able to navigate our schedules and fulfill all our supply obligations while maintaining wallet shares with all customers, hence guaranteeing a dependable and stable supply of products to all our clients. In this backdrop, I will give you a brief rundown of our performance for the fourth quarter and the financial year ended March 31st, 23, and the plans and strategic approach for the upcoming financial year. Mr. Upadhyay will then provide you with granular insights on our financial performance and position. We're pleased to share that Deepak Nitrite has displayed agility in achieving growth while maintaining the high quality and adhering to the safety standards that are expected of us. Diversification across products and user segments, customers, geographies has been a bedrock of our strategy. This allowed us to be nimble and seek out more remunerative pockets of opportunity amidst operational and macroeconomic challenges. This has allowed us to maintain a strong and resilient business model. Leveraging off a solid foundation, incremental investments are tactically utilized to increase capacity and sustain demand from end-user industries. This has enabled us to drive a healthy top-line growth of 17% year-on-year and set a new benchmark of exceeding 8,000 crores in annual revenue, which is the first for our group. Despite recent cooling off in input prices, they continue to remain at elevated levels and more than that, at volatile levels compared to the previous year. While profitability for the year is lower than that of the prior year, EBITDA and PAT in Q4 have grown in double digits compared to Q3, indicating that operations are progressing in the right direction as we enter the new year. Coming to the performance of strategic business units, the Advanced Intermediates unit delivered an impressive revenue growth on the back of resilient demand from end-user industries, and we actively pursued opportunities with both domestic and international customers during the period. We expect this segment to continue performing well, given the shift in global supply chains towards Asia and positive demand trends. However, it is worth noting that challenges around logistics and high raw material costs due to internal product transfers at market prices with a time lag before prices are passed on. Future performance will be driven by several new multi-year contracts, successful pilots, and new product introductions in our basket. Deepak Phenolics witnessed a healthy top-line performance with some contribution from pricing, but largely driven by the continued increase in plant efficiencies. Our phenol plant recorded an average utilization of more than 120% for the quarter and achieved the highest ever quarterly domestic sales in Q4, along with the highest daily phenol production. We've seen sequentially, Phenolics has improved in volume and profitability significantly. This was due to healthy demand and improved product acceptance, resulting in a significant increase in revenue realization for both phenol and acetone compared to the previous quarter. Profitability in the business was lower than last year due to normalized realizations this year compared with the previous period unusually high realizations. The Phenolics business has been using more of acetone in its downstream products, and it is going to increase further upon the commissioning of projects under implementation, such as MIBC and MIBK, which are solvents, and we're optimistic about the prospects for the business in the future. FY23 has also been a year in which a lot of our future growth initiatives have started to take concrete shape. In a key development, debottlenecking is a crucial development for Phenolics, as it enables the company to increase its production, and this is expected to come on stream within this quarter itself. Additionally, the company has approved the implementation of advanced process controls, which is expected to be operational from the second quarter. That project is expected to further enhance the operational efficiency of Phenolics and improve the quality of its products. These developments are expected to strengthen DPL's position in the market and enhance its competitiveness.
I'm sorry to interrupt, sir. We are not able to hear you. Ladies and gentlemen, the line of the management has been disconnected. Kindly stay connected while we try to reconnect them. Ladies and gentlemen, thank you for patiently holding. The line for the management has been connected. Over to you, sir.
Sorry for this interruption. I guess this is now part of new business processes. I will repeat the previous paragraphs. FY24 FY23 has also been a year in which a lot of our growth initiatives have taken concrete shape. In a key development, debottlenecking is a crucial development for Deepak Phenolics as it enables the company to increase its production. This is expected to come on stream in this quarter itself. Additionally, the company has approved the implementation of an advanced process control project, which is expected to be operational from the next quarter. This project is expected to enhance the operational efficiency of DPL and improve the quality of its products. These developments are expected to further strengthen DPL's position in the market and enhance its competitiveness. In addition to our current projects, we're making strides towards expanding our business through several other ongoing initiatives. We've successfully commissioned the installation of our SAC unit, which significantly improves our sustainability in Nandesari. And we are planning to commission the photochlorination and fluorination project in the third quarter, followed by the acid project in the fourth quarter, which will take care of current and future needs. In the first quarter of FY25, we're scheduled to commission our MIBK and MIBC plants, both of which, as I mentioned, are derivatives of acetone. Additionally, our hydrogenation and multi-purpose distillation facility has been approved, marking further progress in our expansion plans. During the period under review, we've achieved significant de-risking of the business through an assured supply of critical raw materials and paying down debt to strengthen the balance sheet. Additionally, with the Nandesari plant back to full operations and other plants running at a high utilization, we are working with good momentum. With multiple plants underway to be commissioned in the coming quarters, we're poised to deliver growth and create value to all our shareholders. Recognizing this, the Board of Directors has announced a final dividend of 7.5 rupees per equity share, which is 375%, a face value of 2 rupees each for FY22-23 in view of the company's steady performance. Before I conclude, I would also like to make a point that DNL's Dahej facility received an unprecedented score of 100 upon 100 in the Together for Sustainability audit. I just want to point out that TFS is very similar. It is a European counterpart to Responsible Care, which is an American institution. TFS is also recognized and highly valued by every single large European company and many large Japanese and American companies. This is the first time ever in the history of TFS that a company has received a perfect score in its first try. We are confident that this achievement is also going to be catalyzing many more such. I would now like to hand the call over to our Director of Finance, Mr. Sanjay Upadhyay, to address this forum and take you through the financial performance during the period. Thank you.
Thank you, Maulik. Good afternoon, everyone, and thank you for joining this call today. I'll walk you through the highlights of the financial results for the period ended March 23. During the period under review, Deepak achieved a positive top-line performance despite facing macroeconomic challenges. In FY23, revenue stood at 8,020 crores, which is significant as compared to 6,845 in FY22, higher by 17%. This growth was attributable to stable demand and high plant efficiency, while EBITDA stood at 1,337 crores against last year's, but it is lower by 19% year-on-year basis because last year's base was very high. PAT stood at 852 crores in FY23 versus 1,067 crores last year. The results have been impacted due to war and resultant high input prices and resultant inflationary pressures. There has also been impact on the several external and internal factors such as summarized by Maulik in his comments. Both business segments showed solid improvements, contributing a strong revenue growth on a consolidated basis. The increase in demand in relation to for key products drove the growth. Despite the challenging environment, DNL remains focused on driving growth and expanding its operations to capture new opportunities. Further, it's worth noting DNL subsidiary DCTL has been actively expanding its team by hiring key personnel in various departments such as projects management, procurement, and support functions. DNL has invested 400 crores in DCTL towards part funding of the group's ongoing capital projects. On the operating front, our domestic business revenue stood at 1,512 crores and 6,410 crores in Q4 and FY23, higher by 22% year-on-year respectively. Export revenues were 449 crores in Q4 FY23 and 1,562 in FY23. On a consolidated basis, domestic to revenue and the mix is 77.23 for Q4 FY23. In the quarter, on a consolidated basis, revenues grew by 5% at 1,974 crores as compared to 1,876 crores in Q4 FY22. The impressive top-line performance was fueled by high production volumes in several key products. EBITDA came at 361 crores compared to 414 crores in Q4 FY22. In Q4 FY23, PAT stood at 234 crores versus 267 crores of last year. Profitability is lower on year-on-year basis due to high base in the previous year, but the company has significantly improved profitability quarter-on-quarter in line with the operational performance. Moving to our segmental performance, in our advanced intermediate segment, revenue grew by 7% to 810 crores in Q4 FY23 versus 759 crores in Q4 FY22. The growth is owing to sustained healthy demand from key customers, while EBIT came at 137 crores with a margin at 17%. As Maulik mentioned, growth in EBIT has not kept with the pace with the revenue growth due to significant increase in input costs compared to the previous year. In FY23, revenue grew by 21% to 3,074 crores and EBIT came at 555 crores, translating to a margin of 18% despite the current environment and challenging circumstances. Deepak Nitrite delivered an encouraging performance with a revenue growth of 3% to rupees 1,173 crores in Q4 FY23 versus 1,131 crores last year. The company has operated all plants except for necessary unit at high utilization rate. The phenol plant has clocked an average utilization of more than 120% or even higher for the quarter and achieved highest ever quarterly domestic sales and highest production per day of phenol. EBIT stood at 177 crores and EBIT margin came at 15% in the quarter. In FY23, revenue stood at 4,986 crores and EBIT came at 594 crores, translating into a margin of 12%. While DNL has no debt, DPL has prepaid the term loan for an amount of 61 crores in the fourth quarter. For the full year FY23, the prepayment of term loan by DPL was 161 crores, leading to a saving in interest cost. This has reduced net debt to equity ratio to almost zero, that is 0.03, as compared to last year's 0.20. On a consolidated basis, the surplus of funds for DNL remains debt-free on a net debt basis with a net worth of 4,090 crores and 2,625 crores of balance sheet. Our balance sheet has adequate headroom to raise growth capital for future expansions. The input on cash flows for the cash flow statement on this cash flow remains robust, and we have reported operating cash flow of 650 crores in FY23 when evaluated against EBITDA of OCF and EBITDA ratio at 4.49. We are entering into FY24 with a de-risked business model, a very robust balance sheet and pipeline of projects lined up for commissioning. We are highly excited of our growth prospects and look forward to building a performance momentum. Before I conclude, I would like to provide an update on the fire incident necessary facility that occurred on 2nd June 2022. Against our insurance claim, we have for loss of material damage, we have received an interim payment of 11 crores for in March 23 and further 14 crores in April 23 as the interim payment. balance is we hope to receive the balance in the coming quarter. Thank you for taking out the time to join our earning call. Now though it is open for question and answer session.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star then two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Nirav Jimodia from Anvil Research. Please go ahead.
Yeah, good afternoon, team, and congratulations on a very good set of numbers. I have two questions. So, one is, when we see our performance in FY20 vis-a-vis what we have delivered in FY23 for the standalone business, I think our gross margins have remained at the similar levels, like at around close to 1,370 crores. But this has come with close to 32% higher turnover when we compare FY23 with FY20. So this could be a combination of a volume growth plus some raw material cost inflation, which you just alluded in your opening remarks. So my question is, with the brownfield expansions and the debottlenecking, what we are undertaking in the standalone business, how much of the volume growth can we expect for FY24? And though some of the raw material prices have corrected, predominantly the ammonia prices, which have corrected close to two-thirds of the prices what they were in the month of December. How much of our current turnover of 3,000 crores in the standalone business has a scope for margin expansion on a per kg basis? So if you can just answer to this, I can add upon one more question to this.
Okay. So first of all, you're right that there has been a lot of volatility, including in ammonia. However, India continues to remain the most expensive buyer of ammonia in the world if I look at the indexes. Nonetheless, it has certainly come down from its peaks last year. Now, what has happened over a period of time also is that the FG prices will automatically correct as they adjust. Nonetheless, we have been able to maintain a reasonably healthy margin on a per kilo basis. And as we expand, in FY21, we had a plant which was about 15% less in terms of its capacity than we have now.
Okay.
So on a stable year, you can expect sodium nitrite and its associated nitrate volumes to increase by about 15 to 18%. And how this results with regards to top line growth is difficult to say because the market continues to be volatile.
Correct.
We continue to maintain reasonably healthy margins, which have been, as they were when ammonia prices were low, as well as they were when ammonia prices were high.
Correct. So, because you rightly said that turnover is difficult to predict because all depends upon the selling prices of the products. But if we see FY20, we were close to 800 crores of operating profit when the ammonia prices were lower. As last year also we were at around 680 crores. So this year would have seen some cost inflation on the operating cost side also because the plant was not running full and several other factors. So what could be the fair assumption based on the volume growth you just alluded upon? What could be the figure we should look upon, because there could be some benefits coming to us in terms of some pockets of the raw material prices as well as reduction in the operating costs. So
Neeraj, I would expect that FY24 and FY21, one reason why they should not be compared is because one of the key raw materials which we used to get as a large volume in a formula-linked price, which was linked to ammonia prices.
Yeah.
Now we are forced to buy it in the spot market at far higher prices. And we have to see how we can de-risk our supply chain itself. So for this year, I would say that one can expect a performance which is in Deepak Nitrite similar to what it was last year if we had not faced the impact of the fire and I think between 40 to 60 days of lost production.
Correct. So we could be closer to FY22 performance in terms of our absolute EBITDA numbers, right?
Let's just interrupt here. You are comparing this with 1920. Am I right?
Correct, sir. Correct. In 1920, we were at 800 crores.
Yeah, but you are just seeing the absolute number. 1920 had a very abnormal year for DASDA. We have been, if you see the con calls and we have always maintained that DASDA is abnormally high, and that's why the percentage is high. So you cannot just pick up one period and then compare with that.
No, sir. Even FY22 also, I think we were close to 680 crores. So I think I just wanted.
Point is, it's not going down. It was one single product, whereas what you are seeing now is overall across all the products, in spite of and despite of rather the several challenges which the industry is facing outside. I mean, it's very difficult to compare. The 1920 period was completely different, and what we are facing, the world is facing now, is completely different. So it will not be the numbers. तो कोई भी analyze कर लेगा. But point is, you must see the outside environment also when we are comparing this.
Correct. So second question is on one of our competitors is also expanding on the NT side. So how we are placed in terms of our existing utilization here, because I think one of the monomer of NT is doing well because of the downstream agrochemicals is doing well. So if you can just help us explain our exposure of sales to the agrochemicals out of our standalone business, and are sales more prone towards the niche generic or the patented agrochemical products where we supply those intermediates?
Okay, so first of all, one thing I can correct here is I do not believe that there are any patented agrochemical intermediates. The other thing that I can say is that we are running our plant at full utilization.
Okay.
We will also be looking at expanding that. We will also be, in our own manner, significantly improving the resilience of the value chain. And we are already also going downstream. We have piloted several downstream products which come out of this chain. Those have been accepted by the customer with regards to quality, and now we are at an advanced stage of discussions for volumes and long-term contracts.
Got it, sir. Got it. Thank you so much, sir. I have a few more questions, but I'll join back in the queue.
Thank you.
Thank you. The next question is from the line of Vivek Rajamani from Morgan Stanley. Please go ahead.
Hi, sir. Thank you so much for the presentation. Two questions from my side. Could you give some color on the demand trends that you've been witnessing for your key end segments in the month of April and May? If I believe in the last quarter, you did say you started to see some green shoots. So it would be great to get an update on that by segment, if it's possible. And the second question was, you've been mentioning that the share of exports has been rising in your portfolio the last 2 quarters. Just wanted to understand what is the margin profile for these export markets vis-a-vis the domestic markets, and if there is a difference, what could be the differential? Thank you so much.
Okay. So first of all, thanks for the question, and interesting that you should mention color and green. But one thing that I can tell you is that our products, which are intermediates, are spread over multiple end applications. You can have the same product which goes into different end applications. However, right now, dyes and pigments is seeing a nadir in that sense with regards to demand and with regards to inventory levels even at customers and consumer ends. The segments which are doing better comparatively are oil and gas, explosives, personal care, food, rubber, infrastructure. And the segments which are relatively neutral are pharma and agro. Now, when I say neutral, I'm talking about it with regards to volumes. Prices may go up or down, but in most cases, we are protected by volume contracts with pass-through clauses. So when I spoke earlier about exporting more, that is because in Q2 and Q3, the Indian demand for textiles when it comes to dyes and other intermediates was very, very poor. Whereas the export need was higher because Europe had curtailed its available supply. And finally, when oil prices were nearer to $120, there was a flurry of activity coming into oil and gas exploration. And as we are intermediates, we were able to pivot away from supplying to a low demand domestic market, which prioritizes textiles, towards a high demand export market, which prioritizes things like water treatment and oil chemicals. Now, this is where we are able to remain nimble. In India, many of these segments have started showing a certain improvement, and hence we have been pivoting back towards India to an extent. Our export markets continue to remain served by us. The margin profiles on a net back basis, I would say, are relatively similar for two reasons. One is that the freight rates have normalized compared to their highs of last year, and B, that there is a duty on our product when it is supplied to the US. So I am talking about net back rates, which also addresses the duty element. So our rates were not lower or higher compared to our domestic rates, and hence in both cases we are okay. We have adequate opportunities to grow in this segment, and we have the ability to pivot depending on end segment demand. And as we will have, this year we will have higher productivity and higher production. We are hopeful that we will be able to cater to the growing demand without needing to lose wallet share from one end segment to another. I hope that answered your question.
Sure, sir. Thank you so much. I'll rejoin the queue. All the very best.
Thank you.
Thank you. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and congratulations on a perfect score through TFS audit. My first question is on phenol capacity. So when we talk about 120%, what is the base we are taking? Is it 200 or 250? And we have again mentioned that we will be debottlenecking further by 10%. So what will be the final capacity that will be on stream in Q1? Thank you.
So base is 2 lakh tons, 200 KT. And when you say, we have said it is above 120, so it is higher than that. And with debottlenecking and this, we are expecting 50% increase in the capacity.
From 2 lakhs?
From the base.
Right. Got it. Thanks for that clarification. So second question is in terms of the domestic demand. So export demand has been very dynamic. What is our understanding in terms of domestic demand for the products which are further being exported by the converters or the downstream players? Thank you.
For which segment are you talking? Are you talking about phenol and acetone?
No, for the standalone segment.
No, it doesn't matter, whether you're exporting it or you're giving it to a domestic converter who is exporting it because the domestic converter has a contractual agreement with an international client. It's essentially the same thing. And it depends on product to product, because in the dye segment, there's not much of this. However, this is much more prevalent when it comes to agrochemicals. And as I mentioned earlier, we in most of our cases, it's not all of our cases in agrochemicals, we have medium and long-term contracts. Some are annual and some are multi-year contracts. So the volumes are relatively protected. As and when we are able to debottleneck and make a little additional volume, we do have customers who we are able to supply that on a spot basis at a spot price.
Sure, got it. So just one last clarification. In our press release or presentation, we have mentioned that there are 2,500 crores projects currently which are undergoing. So what is the completion timeline and capex for FY24 and 25?
What I mentioned earlier is that the fluorination and photochlorination project will commission in Q3. The phenol debottlenecking will finish to a certain extent in Q1, and with the advanced process control, which will further improve on our already standard global standard quality, will start to get realized by Q2. And our upstream project will be commissioned in Q4. And downstream derivative of acetone, which is also a solvent, will be commissioned in Q1 of next year. In the meanwhile, as I had also alluded to, hydrogenation, multipurpose distillation, and a certain amount of difficult, challenging nitration, this will all be commissioned over the end of the second half of the year, all the way till the end of the first quarter of the next year.
Sure. Thank you so much.
Project which we have announced. Finally, one last one which I forgot to mention. The polycarbonate compounding facility will be commissioned over the next 18 months.
Sure. That is helpful. Thanks a lot and best of luck, sir.
Thank you.
Thank you. Ladies and gentlemen, a request to all the participants. If you're using a speakerphone or hands-free, please pick up your handset while asking a question. This is required to ensure optimum audio quality on the call. Thank you. We have the next question from the line of Chetan Thakkar from ASK Investment Managers Limited. Please go ahead.
Good afternoon, sir.
Good afternoon.
So just two questions. One was if you can throw some light on the domestic demand for MIBK and MIBC, and what is the capacity that we are putting up and how do we see that ramping up? And second was on the 2,500 crore capex. If you can let us know how much it is into backward integration and what is the growth capex, and what kind of IRR should we expect on the backward integration project?
Okay. So first of all, MIBK and MIBC, we are targeting for the entire volume of both products to be consumed in the domestic market. We will take the opportunity to export if we think that the realization is better. But the domestic market has significant scope for it. And when we're talking about volumes, we're talking about 40 KT for MIBK and about 8 KT for MIBC. Both of these projects will be commissioned pretty much together.
Mm-hmm.
And with regards to upstream and downstream integration, I would not consider that to be a crucial question. The upstream integration will be able to significantly add to our bottom line, no doubt. But while we're doing it, we are also confidently expanding our consumption capacities, which will therefore add to the top line. And those expansions come at a fraction of the capex that the upstream distinct projects require. So net, I will look at even the upstream integration to be able to generate growth with minimum investment in debottlenecking of our existing products. And as usual, we don't get into a lot of detail about the capex involved when we're talking about debottlenecking of products.
Got it. And so, just to get a sense, the domestic total volume for MIBK and MIBC? So 40 and 8 is what we are setting up, or 40 and 8 is the domestic consumption?
Both of these are the same. We are confident of being able to take 100% of the requirement. Let's also keep in mind that the requirement is growing at a healthy CAGR. So we hope to apply ourselves to seeing how we can debottleneck this in short order after commissioning. But we're confident that we should be able to take as close to 100% of the consumption demand.
Today it is 100% imported, which is in the same range. So that's what we'll be able to supply to the market, substitute the import.
Got it. And on the 2500, so the total capex that is there, is it fair to assume that since we are moving up the value chain, our payback time should be anywhere between 3 to 4 years for these projects, which is essentially faster than what it would have otherwise been?
Yes, you are right.
Yeah, this is a correct assumption.
Sure. Okay, sir. Thank you so much. All the best.
Thank you. Just I'll highlight that, when we count payback, we are only considering the incremental value that we get.
Got it. Yes, sir. Sure. Thank you.
Thank you.
Thank you.
The next question is from the line of Abhijit Akella from Kotak Securities. Please go ahead.
Yeah. Good afternoon, and thank you so much for taking my questions.
Hi, Abhijit.
Hi. First of all, on this government incentive that's mentioned in footnote 3 of the results, it was about 59 crores for the year compared to only 1 crore the previous year. So just wanted to check if, whether this is the usual export incentive or it's something else, and is it a one-off item or do we expect it to continue in the future?
Abhijit, can you come back on the question, please? One is incentive. What is that question?
Yeah, I was referring to footnote 3 of the results, where there's a table showing the government incentive income. It shows about 59 crores for FY23.
Yeah, 59, right.
Compared to only 1.6 crores in FY22. So
right.
was just trying to understand what this item exactly is, and is this a recurring item going forward?
It is a recurring item going forward. This is incentive given by the government for setting up the project, and I believe this will continue for next 5 to 6 years.
Okay. Is this at Deepak Chemtech or at Deepak Phenolics?
This is Deepak Phenolics.
Okay. So we should expect the same number to sort of continue for the next 5-6 years.
Numbers may vary up and down depending on, there are various parameters on which the incentive is given. But you can roughly take the same amount year on year, not an issue. Can be a little higher also.
Sure, understood. Thank you. Second thing was just on the polycarbonate compounding capacity. It would be helpful if you could please guide us a little bit on what sort of value addition we should expect, between the compounding the product versus the base polycarbonate that we'll eventually produce. So, in terms of maybe the price variance or the difference in margins, how much would roughly we expect on that?
Abhijit, this is rather than looking at this facility as a EBITDA increase or something like that. More important is that we are setting a base for polycarbonate. When you are going out with polycarbonate, if you go with just a polycarbonate without knowing the market, then it will not be the right. In fact, we want to go further one step beyond, not just polycarbonate, but little polycarbonate derivatives also, so that we have edge over the normal. There are various applications of polycarbonate. Which application makes sense for us? Where to go? Where is the strength lies, and where is the demand growing? These are all parameters we'll test by getting into polycarbonate compounding facilities first, for which we have sanctioned 250 crores, and we are actively working on that. Parallelly, we'll start work on polycarbonate, but this has to happen first. This is a precursor to the polycarbonate. It will certainly, when you select the right application, your EBITDA is bound to go up than normal polycarbonate. I will refrain from giving any numbers now because we are ourselves studying, but it's the whole idea is to make your product more, I would say, not a commoditized product, but somewhere it is getting a color of value addition.
I'll just add one point here. This is what you would consider as seed marketing, because customer approvals, especially for high value compounds, it takes anywhere from 6 months to a year and a half. So our goal is to make sure that we put our foot in the door there. Now, of course, it is a cherry on the top that the financials do look attractive in any way. when we're talking about the compounding facility. But the purpose of investing these few hundred crores is so that we can fast track the approval and validation process with the customers. And in the meanwhile, we work to see how we can connect between our current product portfolio and the manufacturing over a period of time, so that we are end-to-end completely integrated.
Thank you. That's helpful. Next question I just had was on the contracting within the business. The presentation does mention that significant part of the business is contracted. So if it's possible to give us some sense of, roughly, what percentage of the volumes might actually be contracted, and what's the pricing arrangement on these? Are we sort of giving 3 monthly pricing arrangements, or is it longer than that? That would be helpful. Thank you.
Ladies and gentlemen, the management line has been disconnected. Kindly stay connected while we try to reconnect them. Thank you. Ladies and gentlemen, thank you for patiently holding. The management's line has been connected. Over to you, sir.
Yeah, Abhijit.
Yeah, sorry, I'm not sure if you heard my question, sir. I'll just repeat it.
Yeah.
It was basically with regard to the, let's say, the volume of contracted arrangements in the business. The presentation mentions that there is contracted supply of products from both the segments, which provides high visibility for continued growth. So just sort of wondering, if we could share what percentage of the business might be contracted in both the businesses, and what sort of pricing agreements do we normally have? Is it on a quarterly basis for these contracts, or is it longer term?
I will ask about answer about the pricing first, because pricing is not, it's always formula based. In today's world, nobody gives you a fixed price unless it is only a couple of months or a maximum for a quarter. So there is no fixed pricing arrangement in most of the cases. In fine and specialty segment, yes, there will be a few contracts where it is fixed pricing, but their margins are certainly in our control and that way. In BNL, this volume should be in the range of around 25 to 30%, whereas DPL is in the range of 20 to 25%, the contracted business. Okay. But if you know, by and large, we have same set of suppliers in BNL also, in DPL also, and they are with us for years and ages. DPL also we are supplying to the most of the large consumers, and they continue with us. In today's market, nobody enters into a long-term contract, which you also know.
Sure. No, thank you so much. That's really helpful. Just one last quick clarification, and I'll get back in the queue. On slide 7, we have shared some volumes. So, for example, sales of inorganic intermediates of 7,600 tons and hydrogenation volumes. Just wanted to clarify, are these for the quarter or for the full year?
7,000 would be in a month.
For the quarter. Inorganic.
We will come back to you with this answer. Sorry about that.
Sure. No problem. Thanks a lot and wish you all the best.
Thank you. We have the next question from the line of Rohan Gupta from Nuvama Wealth Management. Please go ahead.
Yeah, hi sir. Good evening and thanks for the opportunity. Sir, first just clarification on this our phenol business in terms of the sourcing and availability of ammonia, where you have said that we used to have a lower cost availability, but the things have
Sorry
changed
to
now.
interrupt, sir.
In terms of our
Mr. Gupta, your voice is muffled. May I request you to use your handset, please, to ask a question?
Yeah, just a second. Yeah, hi sir, hope it is better now.
Yes, sir. Please continue.
Yeah, sir, I was asking on ammonia sourcing and for our phenol production cost. So, how do you see that you have mentioned that the changes has been there already in place for the cost structure what we have enjoyed earlier versus going forward now. So, with the falling gas prices globally and also in India, how we see that our gas cost and ammonia cost of production ammonia cost will come down, and how the phenol spread in your view is going to move in near future? If you can just give some